Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. We're back with his good friend, Dan Bird. And boy, I love having these conversations Sunday with you because it allows me to look backwards and also look forward. And
Yeah.
last week was interesting, and I don't think next week's going to disappoint either. So what's going on in the market? What do you see?
What do you mean? What do you mean by disappoint? You mean exciting?
Yeah, it's exciting. It's
going to go down? Is it going to go up?
Well, I don't know. I mean, nobody really knows, but it's never boring. We have a lot of stuff going on. Yeah. I did call one thing last week that I'm pretty proud of. I proposed last week that there were 5 big banks reporting.
Yep.
And I said one of them, at least one of them, is going to talk about loan demand already crashing, which is really odd because in the real estate game, last quarter, we only kind of saw half of the interest rate jump, right? This last 100 basis points has been after the quarter.
Right.
So that was a pretty aggressive call. And sure enough, Wells Fargo, 33% destruction of loan demand. Right. JP Morgan, by the way, was down 3%. But yeah, Wells Fargo, who is by far the bank, if I had to pick one, is the one I would have picked. The other 4 banks kind of had an okay quarter, with JP Morgan revenue down 42% year on year, but most of them made it up on trading.
Yeah, I was just going to say that.
So
Wells Fargo does not have a strong trading desk, no, but the other 4 do.
Yeah, for sure. And they all Morgan Stanley, Goldman Sachs, JP Morgan, Citigroup, all of them highlighting the trading desk, which to me means somebody out there missed, like maybe it's UBS or some other international bank, because there's a lot of short-term trades, a lot of momentum, and somebody's going to be left holding the bag. And maybe we'll find out next week who it is.
Well, I think because of the trading desk strength, I think a lot of those banks have been watching my YouTube videos with you.
That's right, of course.
How to do credit spreads.
Yeah, exactly. Yeah, so it's been fun to watch. So why don't we talk about inflation? Because it exceeded expectation, but frankly was below my call of 8.9. It feels weird to say, it only came in at 8.5%.
Yeah, I'm going to share. Let me share. I'll show my my rolling 12-month chart.
Yep.
Which I've updated with the 8.5.
Nice.
All right. So again, 6.6 is what Fannie Mae had called for the year. So that it could end up being wrong, obviously.
Of course.
But if it is correct, then all of these estimated have to be adjusted in order to maintain that 6.6.
Right.
So there's the 8.5 that was just added. You can see the current chart still going up. The interesting thing on CNBC and all the talking heads, if you listen to any of that last week, and I don't listen to it very much, frankly, because I'd rather let the price tell me where the market's going rather than talking heads.
Of course.
But when I did tune into it on the day that I like to do it when the inflation numbers come out or when the jobs numbers come out, because I can see what's happening right then. They're all talking about peak inflation.
You're right.
They're all saying, this is it. This is peak inflation.
This is the high number.
Right. And
which is something we've highlighted because the base effect, right?
We've been saying that for a while.
Yep.
And this shows it right here. This actually shows that base effect and what it will look like if the 6.6% holds. Now these estimated, they could change.
Right.
So I've got it going from 8.5 down to 8. Next report, it might go to 8.4, but I will guarantee you, if it's anything less than 8.5, everyone will be talking about it.
Yeah, the April report, which happens the day after. When does that come out? So it'll be
April it'll
be May.
It's in May 14th.
Yeah, so it'll be so what that means to me is the Fed will raise on the 4th, which is their first meeting, and that will be 50 basis. It's baked in. The question is, will they follow up with a 50
Yeah, so I
June.
put that in my news. I'll bring my newsletter up here in a second, but let's talk about this for a second,
Sure.
just to complete this thought.
Okay.
So if we assume these estimated are going to be pretty close and it's going to end up at 6.6, then that means we did just have peak inflation.
Mhm.
And from this point on, it will start to trend down. Now, one data point will not make a trend,
Correct.
even though one data point will get all the talking heads talking about the trend is there.
Mhm.
And they'll all say, you see, I was right last time, last report, which was last week.
Yep.
It was peak inflation, just like I said.
Yep.
So everyone will be talking about it. So
Of course.
it'll be interesting to see, and I will update this every month as the actual numbers come in, and we'll see, how this actually turns out. Now, let's. I'm going to bring up my newsletter, and because there was a piece in there about what you were just talking about. Right here. Actually, I think it's actually in my, let me do this. I'll do it this way. So here's my newsletter information. If anybody's interested in joining, it's just send me an email to breakpointtrading@gmail.com. This is an excerpt from this week's. So this is what we just talked about here on the left. But down here is what I said. So we won't know for sure until June, because you need 2 data points to make a trend, right?
Yep.
Which will be the main number. Although any number below 8.5 will get lots of airtime.
No question.
Interestingly, the June CPI report is on 6/13, and the Fed meeting is on 6/14.
Yep.
So they will almost guaranteed raise by a half a point.
Oh, in the May
meeting, May 4th.
It's 100% across the board. I haven't heard anybody think it's not going to be 50
Right.
in
That's
May.
right. And on June 14th,
Yep.
they will most likely raise another half a point.
Correct.
Even though the CPI report will likely show a downward trend.
That is certainly what they are banking on. Yes.
Which is the day before, the Fed meeting.
Agreed.
So what I'm saying, could a clear peak inflation trend in the 6/13 report lead the Fed to start talking about pausing their rate hikes, even if they still do another half point in June?
Oh, I think you're already kind of seeing the future. I think that's exactly what they're going to do, right? They're going to say, they're even going to bring up the word transitory again, I'm sure, right? We finally broke the back of inflation. It's finally over. Blah, blah, blah.
But now we want to make sure. So here's a half a point.
Yeah, exactly. We're going to follow through because we're tough.
But their wording will say, we reserve the right to pause future hikes or reduce future hikes based on the trend of inflation. And that will cause the market to start to go up. So that at least temporarily.
Yeah. So that will happen on the 15th, right? Typically speaking, Powell will get up and talk about 11 a.m. Pacific, 2 o'clock Eastern on the 15th. The 50 basis point will come, then you'll have your talk. And then about 3 weeks later, we'll get the meeting minutes for further validation. That's kind of how it unfolds.
Right. And I expect, and this is what I predicted last time we talked, I expected 2 50-point hikes and then a 25.
Yeah, I think.
Then 25 will be in July.
Okay.
So that's going to put us at what?
1.5.
1.5.
Yeah.
Right. They might do another quarter.
Okay.
Getting us to 1 3/4 in August, but I think they will definitely pause after that.
Okay.
I don't think we're going to get to 2 by the end of the year, or we might get to 2 right at the end of the year.
So December. Yeah.
December.
Yeah. I think you certainly could be right. Absolutely. I'm certainly above that. Although I'm not as certain as I was maybe 2 weeks ago, but yeah, I'm still calling them to be between 2 3/4 and 3%. So quite a bit higher by the end of December.
Yeah. I'll show you. Let's see. Let me show you some charts here. That's the VIX. Here's CPI. So here's the CPI chart. That CPI is monthly, so that's why it just looks like a single bar, because it's only reported every month.
Yep.
Here's the March number right here.
Yep.
And this kind of highlights that 12-month period.
The big
the base effect. This kind of highlights the base effect.
Yeah.
We had all these really low numbers way back here.
Mm-hmm.
And every 12 months, these low numbers started to fall off. So what happened when the inflation started going up and then it started to accelerate right here, this pink line across here is basically where it has been for years, going back practically a decade,
right?
Below 3, right?
Mm-hmm.
And right here in April of 21, a year ago, is when the rate of change broke through that 3 level. And because inflation started going up, but we still had all these low numbers back here.
Yeah, really.
The rate of change, the rate of change looked like it's accelerating.
Yep, correct.
Which it was. I mean, it was accelerating. So then we move forward and the rate keeps going up. And as this goes up, we drop off more and more of these low ones back here until we get here. And now the low ones are mostly dropped off. There's still a couple of sort of low ones still in there, but not nearly as low as they were.
Yeah, but also let's put inflation in context and what this base effect means. So let's just pretend you have $100. Okay. So, and we're going to do round numbers so the math is easier. So let's assume inflation was 10%, right? So that $100 basket of goods is 110. Now, bingo, bango, magic happens. The low numbers roll off and suddenly you're reporting a 5%. That 5% is on the 110, not the 100.
That's right.
That's what people need to realize is there's a compounding effect. So
yes, well, inflation will still be high.
Exactly. So people don't focus on the 5 versus the 10. You're still adding inflation on the higher number. And that's why inflation is so toxic.
Yeah. Yeah. It's 8.5% increase from a year ago.
Exactly. Not some artificially low number.
Right. So even when this rate of change starts to decline, which I think it will start to show in the May report, and it will only be one data point. So
you're gonna need to,
for the April number, I think will start to show it's already flattening. Right. But the April number will start to show this rate of change declining. So yes, inflation will still be high. I mean, even if it does come in at 8, or let's say it comes in at 8.4. Yeah. And everybody starts running victory laps.
Oh, I think, yeah, dude, I mean, there's a chance it comes in at 7.7 or 7.8 or something. That is still a horrible number.
Yes.
And it's a horrible number on a horrible number. So celebrating a 7.8 doesn't help the mom. I was that kid at the grocery store with my mom looking at her coins going, Michael, I don't know. This is how bad it is for folks. I know it's coming. My mom would put the base groceries on, and then she would have this, like the top end of the grocery cart, that little, I don't know, like where the kids sit when they're young. She would put the extras there. Like if she had enough, she would add one more. And then if she didn't have any money, that stuff was left behind.
And you would be standing in front of the candy bars.
Well,
going, can we get this one, Mom?
And she was worried about, just different levels of stuff. So it is really bad. Inflation hurts the poor the most. Yes,
that's very true. It absolutely does hurt the poor the most. Because people that have money, or actually a better way to put it is understand money and know how to generate wealth, they will know what to do when this happens.
Yep.
I talked about it in my newsletter again about the different sectors. And when inflation starts going up, the energy sector is the one that typically takes off first.
Yeah, energy, utilities, healthcare, right? Yeah.
Yeah. Well, healthcare, utilities, and staples, consumer staples.
That was the last one. Yeah.
They all are defensive sectors, and they will increase. But energy, because of inflation, will increase the most.
Agreed.
It will have the biggest rate of change.
Yeah.
And in fact, if I go back to my newsletter, I had a lot of stuff in my newsletter this month.
Yeah, it
by
was
the
a good
way.
read. Yeah. It was
So this was a really good one. Bill O'Neill from Investors Business Daily. He always says, do a top down. This is what I always like to do. Overall market direction, best performing sectors, best performing industries in those sectors, best performing stocks in those industries. And then I put a link in here that everyone should, put on their favorites list.
Okay.
23 trading rules and 10 common mistakes most traders make.
That's a book.
That's just a link.
Oh, okay. All right.
When I click on that, it shows you.
Gotcha.
And what is Ken Slim? Here's the 23 trading rules. Don't buy cheap stocks, buy growth stocks. Make sure the last two. The very last one, 37% of the stock's price movement is directly tied to the performance of the industry group, and 12% is tied to the strength of the sector.
49% total. Wow.
49% of a stock's move is based on the group that it is in.
That's awesome.
All right. And then 10 common mistakes that most traders make, which are really important things to look at as well.
I like it.
But at any rate, if we go back over here, so that was, I don't know if people know that you can click on these links that I put in here, but
yeah.
So I put this in LinkedIn. This is the discretionary versus staples. This is a chart I always like to look at.
Yeah.
So what this chart tells you, it's a relative chart. So if you look up here, it's XLY, which is the consumer discretionary ETF for the S&P, and XLP, which is the consumer staples ETF for the S&P.
Yep.
Consumers make up 2/3 of the GDP.
For sure. Yep.
So it's important to watch what consumers are doing.
It's the only, that's who I've studied for 30 years, the consumer, not necessarily this index, but the consumers drive the market. If you can figure out where they're going or where they're scared, you can make a lot of money.
Right. Absolutely.
That's why.
Because it's a relative chart, the one that comes first is the direction. So XLY, consumer discretionary, if the chart is going up, then discretionary is outperforming staples. Just if the chart is trending up, discretionary is outperforming staples. If the chart is trending down, staples are outperforming discretionary. Staples are defensive. Those are things that people need to buy. Discretionary are the things that people want to buy. Just like your analogy with your mother. She was buying staples.
Absolutely.
Because she couldn't afford the discretionary stuff.
Oh.
And that's what happens when inflation hits and when recessions hit.
Yes.
So if you look at this chart, keeping in mind, and this is basically, the pink is the 8-day, the blue is the 21-day. Hopefully by now everybody knows what my charts are made up of. 8-day crossing the 21-day, the red one is the 50, and the dotted gray one is the 200.
Got it.
So when the pink crosses over to the downside, the 21 right here, that means staples are starting to outperform discretionary.
Got it.
The market is becoming defensive.
Yep.
That happened in December when the market was going up. Actually, you can see the market. I don't have the market on here, but so that happened in December. Remember, December, the market was, it's right here. It's right back. This black line is the S&P.
Yep.
All right. So the market continued going higher, even though staples started to outperform discretionary. So we had about a 3-week lead time, canary in the coal mine, saying, yeah, the market's going up, but don't get too confident because the market is going up because staples are going up. Traders are buying staples or getting rid of discretionary.
Yeah.
All right. So that was a 3-week lead time before the market rolled over. Right here, you can see the green line is discretionary. The red line is staples. Green line crossed over staples right there. And that was the peak. Market started going down. The pink line stayed below the blue line all the way down to here. Crossed back above it. So briefly here in March, when we had that 2.5-week rally, people started buying discretionary and technology.
Yeah.
Again, right? So the pink line crossed over the blue. The market started heading higher, but discretionary really never caught up to staples down here.
Obviously you're into the market much greater than I am, but when I look at what's going on, there seems to be a large cohort of buy the dip fans, very
Yes.
focused on technology,
Yes,
that just want the good times to come.
absolutely. Come back, you mean? They wanted to come back.
They wanted to come back. Or they're like, they're here. It's just another buy the dip moment. And I'm afraid that those folks are about to suffer a washout like I did way back in the .com era.
Yeah, I don't disagree with that. And in fact, interestingly, I mean, this goes back to the very first session that we did.
Yeah.
Where I showed you this slide.
Mm-hmm.
It's not a Ponzi scheme. It's a buy the frickin' dip scheme.
Yep, exactly.
So this left-hand side is last year.
Yep.
This right-hand side is this year.
Yep.
And the buy the frickin' dippers are still trying to buy the frickin' dip.
Yeah, that's what I see going on when I look at the numbers, given all the training and education you've given me. I'm like, this does not feel right. It looks like the Wall Street, if you will, smart money is getting out. They're already rotating. It takes them a while to move.
Yep.
And buy the freaking dip, the meme guys are still trying to make it. They're still trying to push. And
well,
it's gonna
if you do nothing more than just look at this chart, and I didn't put a link to this chart in there, but I will next week. Mm-hmm. And I'll explain why in a second. But if you just look at this chart right here, and all through last year, I mean, discretionary was outperforming staples. Yep. And that includes technology. Right here in December, even as the market was continuing higher, that's where the rotation started.
Yeah.
Right there. That's where all the big institutions started distributing.
Exactly.
Started selling all of these great profits that they were making.
Mm-hmm.
And they sold all the way down here, and then they let the market start buying. They let the buy the dippers start buying, and look what they're doing now. So this is here just a week or so ago.
Yeah, I think again in video 2, folks, we're going to talk about specific stocks. I want to get to that. Dan, can you show your website or your newsletter one more time? I want people, if they want to get it, it's free. I look at it every weekend.
Yeah, 2 quick things.
Sure.
This right here, I put in my newsletter. This is the cycle. This is the market versus the economic cycle. And this highlights that the market is 6 months, typically 6 months ahead of the market.
Yeah.
I mean, 6 months ahead of the economy.
Correct.
Okay. And this tells you the different sectors that are in favor. This helps you understand rotation, just like you were talking about. So when the market's coming off of the bottom, finance, technology, cyclicals, which are discretionary, technology, industrials, materials, and then when it gets to the top, materials, energy, staples. That's the rotation that I just showed you in December. That's the rotation right at the top. Now this is the stock market. This is the top of the stock market, but the economy continues going up. So even as the stock market's rolling over, all those buy the dippers, those retail people aren't understanding the stock market. They're understanding the economy.
Yeah, it's different.
And they're saying, wait a minute, the economy is still going up. It's still healthy. Earnings are still great.
Yeah.
Companies are still doing well. Yeah, but the stock market is 6 months ahead of the economy.
Every time.
So the market starts going down as the economy peaks. And I think we were right here, right now.
I agree.
We're right here at the full recovery of the economy, but the stock market heading down. And we've got this whole other leg over here on the right-hand side to go through. And
the good times.
And you can see the recession right over here. I mean, if you just understand this from a high level view of the market, this is so important to understand what's going on. And then these are the sectors here. And I showed these last week. I showed these charts. But in this newsletter, and I didn't put this in, I should have put it in there, but in this newsletter, I actually provided links to each of these sector charts. So if we look at technology, it'll take you to the one that I showed you last week.
Right.
There's technology. It looks terrible.
Yeah.
Right. But each of these links, when you click on it and it takes you over to that chart, you can save this chart to your favorites list and it will continually update for you.
That's awesome.
And you can go in and look at these sector charts yourself. Just from what I've given you in the newsletter, these links right here, you can look at each one of these sectors every day or every week on your own. Just put them in your favorites list.
Every week for me. I'm not in this as much as you. This is just another, I use these to kind of get a feel for what the consumer is doing, which again, I think is a leading indicator. or smart money. So it's
Yeah.
this is a lot
And
of value here.
This is another thing that I mentioned. This gives you an idea of the allocations of the different sectors.
Yeah.
And you can see this is why technology drives the market when it's going up.
Of course.
It makes up, I think it makes up like 37% of the S&P, but actually 24% of the S&P technology, and then communication services, which is includes all of the internet companies.
Yeah, it's lumped together. Yeah.
Right. So that's 36% right there. But you can see that the allocation. So energy, remember I said energy really starts to take off when inflation goes up, but it only makes up 3.6% of the S&P, right? So even though that sector might be getting ready to take off, it's not going to necessarily be reflected in the overall S&P.
Yeah, it can't be. It's mathematically impossible.
Right.
When you've got 36 or 37% crashing 10 or 12%, energy could go up 50% and it won't.
Right.
The math doesn't work.
That's right. But if you understand this,
yes,
and sector rotation, and you understand there's energy right there at the top of the stock market, and here's energy right here as the stock market is going down.
Yep.
And if you click on the energy graph right here, you can see, even though it only makes up 3.6% of the overall S&P,
looks good.
Way back here in the beginning of January, when the pink line crossed the blue line, and you would say, energy's coming back. Let me find the best stocks in the energy sector and buy those stocks. And look what it's done since then.
Yeah, exactly.
It's actually getting its second wind right here. So inflation is not slowing down, and neither will energy.
Yeah, I agree. Do me a favor, show your newsletter one more time.
Yeah.
Folks, if you're listening on the podcast, it is breakpointtrading@gmail.com. It's free, no upsell, nothing. He puts this together. I read it almost every weekend. His cartoons every weekend. They are hilarious. Dan, thank you very much.
For no other reason, I should charge just for the cartoons. but then I would have to pay whoever made these cartoons. So
yeah, no, don't do that. Yeah, have fun with it. Thanks, buddy.
All right, take care.